Hello there. I'm Robert Promisel, one of the global portfolio managers at Resolution Capital. Really pleased to be joined by Don Wood, the CEO of Federal Realty. Federal is one of the oldest REITs in the US, established in 1962. It focuses on the shopping center industry, really the shopping center plus industry, which we'll get into. Don, I just wanted to turn it over to you if you could introduce your company and talk about some of the key points of difference for Federal, what makes it special.
Sounds great, and good to see you, Rob. Thanks so much for giving us the opportunity to address you folks. Federal is one of the oldest REITs in the country. It was formed in 1962, and it's interesting because of that perspective. It was formed by two State Department workers who were watching the changes in the tax laws at the time, and the REIT law had just come into effect, and they said, we might be able to start a business here that does better for us than working for the State Department. And so they started Federal and named it Federal, which is why it's called that. From the very, very beginning, the MO of this company, the modus operandi of this company has been to create a growing stream of cash flows through cycles, because real estate is cyclical. Always was, always will be. The shopping center business is certainly cyclical. And most of the product that is a shopping center, is generic and is a commodity. That basically means goes up with good times, bad with downtime and bad times, etc. Our MO was how to create something that was better than that. How could we create something that withstood recessions, that withstood high interest rates, et cetera? And if you look at the company through that prism, which not only was done before me, but certainly done every day since me, and I joined the company in 1998, I think you can get to why it is that we're different and why it is that I believe that we've got the best business plan in the space. First of all, if we were all sitting around trying to develop that business plan and it had to create an income stream that continued to grow through cycles, the first thing I believe we would do is be very selective on the properties that we bought. So we call it high quality real estate in the best markets. Frankly, everybody says they have high quality real estate in the best markets. But let's put some meat around that, what that means for Federal. Basically, because our company was formed in Washington, D.C., and the founders lived in the suburbs, we became experts at that first ring suburb, first of Washington, D.C., then of Philadelphia, then of New York, then of Boston, and eventually to the West Coast, beginning in the 90s, the same kind of way. We're not downtown CBD, Central Business District owners. We are that first ring suburb. And if you think about what has happened since the 60s and the 70s and the 80s in those suburbs of those major markets on both the East and West Coasts, those suburbs have become very dense. They're very affluent in the submarkets within them that we're in. And most importantly, and this can't be ignored, they have huge barriers to entry because they're built out. So I'll get into in a little bit one of the biggest differentiators of Federal being a mixed use company. In addition, we went into mixing uses, and that is residential and office on top of retail. And that happened because in the markets where we were, those suburbs densified. And since you can't spread out and go horizontally, the only way to go was up. Retail doesn't work on the 5th or 7th or 15th floor. And so we developed a capacity and I think a strong expertise to be able to build buildings and neighborhoods that had other uses on top of the retail.
Right. Let's just interject. Sorry, John. Let's just interject a couple points here. So just over half the income your company is generated between Washington and Boston. So real big focus on a very dense part of the U.S. And as you said, locations in close-in areas that have become affluent over time. But you've also moved into the West Coast. You have Silicon Valley, Southern California, both LA and San Diego, and then more recently you moved into Phoenix. Presumably, when you moved west, you've also focused on similar market characteristics as you've been. And then, of course, I've left out what you've done in South Florida, just south of Miami. Right. And then from a mixed use point of view, roughly 40% of the portfolio income is from mixed use projects.
Yeah, and let's dig into that for a second in terms of what that really means, Rob. So in three major places across the country, in major markets that we're in, we embarked starting in the 1990s and then in the mid 2000s and into the 2000 teens, three major projects. Pike and Rose in North Bethesda, Maryland, which is a Washington, D.C. Suburb, Assembly Row, just outside of Boston in Somerville, Massachusetts, and Santana Row, which was the first one in the middle of Silicon Valley, San Jose, California. In each of those three major markets, we have invested $1 billion or more, so they're big, in creating neighborhoods that were mixed use. The residential and the office components of those make up gosh, I want to say almost 60% of the income from those three projects. But when you think about why that office component, as opposed to office in America, and that residential component is so successful, it all gets down to the retail. What did we do on the street to make that place or those places so attractive that people will pay a premium to live there or pay a premium to work there? Right. The lessons that we've learned over the 20 years with respect to those three projects have permeated the rest of the portfolio. And it's a huge differentiator. If you think about it, because those projects are more complicated, they are certainly they have a lot more dynamics associated with them. What we've learned with respect to construction, what we've learned with respect to tenants and our relationships with different types of tenants, what we've learned with respect to operating efficiencies, specifically green initiatives, with respect to those densely populated places, that have permeated the rest of our shopping centers. So a normal commodity looking shopping center in Federal Realty's portfolio, I would suggest to you, is a whole lot better because of those things that we learned at those large projects. Now, we're not going to do another one like that. We're not going to do another $1 billion project. We don't need another $1 billion project. But what they have spawned are smaller $150, $200 million investments in places like Coco Walk with the same characteristics in Miami, like Darien, Connecticut, with the same characteristics as those larger projects, and another dozen or so throughout the portfolio. It's a really interesting mix that really differentiates this company because we're multifaceted. We're not a one-trick pony. And the way you create value is you've got to be able to increase rents over time. In order to be able to increase rents over time, you need to be in markets where there are more and better jobs, people with money, lots of those people, and importantly, not the ability to just go horizontally and have somebody create a competing product right next door. So it's a very unique business plan, I think.
Yeah. So there's so many ways to go from here. So one of the things that strikes me is a picture is always worth 1,000 words. And I'm looking at you as you're talking, and I know where your office is sitting. I look over your shoulder at what used to be a single-story strip shopping center anchored by probably a fabric store and a really underutilized low-density use. And I'm just looking at what you've created. Maybe you just talk a little bit about the buildings behind you as a representation of what you've been talking about.
Well, yeah, I'm really proud of this. This is exactly what I was talking about. I'm at Pike and Rose, which is where our headquarters moved to Actually on August 10th, 2020, we moved into a building we were building. How about that?
Interesting timing.
Yeah, it was. And it was a piece of land that Federal has owned or controlled since 1985. And it's in North Bethesda, Maryland, which was a typical suburban location with, as Rob says, one-story ugly shopping centers. This one was one of the ugliest. It was called Midpike Plaza with G Street Fabrics. I'm glad you remember that, Rob. And we knew we were sitting on gold in terms of what was happening around us, what this should be, and the choices people had. There were not places that folks had the ability to live in a more urban type environment, yet still be able to use their cars, have plenty of parking, etc. So what you see here is the second, third, and soon to be fourth phases of Pike and Rose on the same 24 acres that used to be, as Rob said, a one-story ugly shopping center. And so behind me, you're looking at a residential building on top of a hotel, on top of street level retail. This project itself has about $900 million invested in total now. By next year, as rent starts in some of our newer product, we'll be earning over 6% yield, unlevered, on this asset, and I believe it would trade well below that. So I believe we've already created value, even though there's an awful lot more to come. So that's, if you can imagine that, this is only one project of a market, the Montgomery County, Maryland market in specific, Washington, DC in broader context. You can imagine in doing something like this, how this finds its way to improving the tenancy, improving the product, improving the rent growth at our other Montgomery County properties, which are very close and adjacent to Pike and Rose. It's a huge differentiator. I don't think most people understand.
Right. So the cluster you have in that Bethesda plus corridor is really remarkable because you're able to, I imagine, move tenants around if you need to in a way that improves traffic flow to the project. So, for instance, you guys, you moved there from, is it Congressional Plaza up the road? Yeah. And then in Congressional Plaza, you backfilled it with a daily use. I think there's a children's school that's come in. Yeah. So I only mention that because I think it's a different driver of traffic at Congressional Plaza with the food and beverage. And you're able to, through this clustering, I think you must really be able to have some real leasing power.
Well, I think what's important to understand, and it's hard to explain it. Rob has seen this, so I know in your mind's eye you've got an idea of exactly what I'm talking about here. But just let me try. You know, we've got a couple of million square feet here in Montgomery County, and we're trying to serve all different customers. So the daily needs customer goes to Federal Plaza. The big grocery customer, it goes over to Montrose Crossing. The lifestyle customer goes to Congressional Plaza that Rob is referring to. But all of them are in a place that has seen job growth, seen income growth, very important, and has great educational fundamentals in the college system, the secondary system here, very critical. Marry education levels with income levels, and you'll see correlation there that's critically important, and job growth that's critically important to continuing to create value. Anyway, they've allowed us to do residential at Congressional, where Rob is talking about. Our offices were there. When we left to come to Pike and Rose, those offices were backfilled by a childcare facility. The optionality at Federal, I believe, is much greater, not only because of the locations that we're in, but because of the expertise we've developed. I mean, a regular shopping center company with that opportunity doesn't have the ability to build a residential building over retail and create a place And we've always been about place. And COVID, frankly, coming out of COVID has been such a positive from the standpoint of
Interesting.
reminding human beings and consumers that we're social creatures. And when you think about being social, that mix of tenants, which should include food, restaurants, which should include gyms, which should include small shops, big boxes, everything needs to be packaged in a place where you're just comfortable. And what we try to be is the living room of the community that you live in.
That's great. So let's talk a little bit about your tenant mix. Because as an open air shopping center company, you obviously have a fair amount of grocery exposure. But as you mentioned food, I think you also were alluding to more leisure activities like restaurants. And so, yeah, how do you think about what your tenant mix is, and going back to what you said earlier about how you could create assets that have income that endures through economic cycles?
Yeah. Well, let's think about this a little further. The every retail destination, I'm going to call it that, whether it's a grocery anchored shopping center, a mixed use facility, a power center, whatever it is,
Hmm.
it has to talk to the specific marketplace that it is trying to reach out to. And that's really important because that's not the same. I hate one size fits all. I don't believe it fits all. But in real estate, anywhere, I think real estate is very, very local as a business. I think one of the biggest challenges of REITs as they get bigger is to not be generic, is to not be factories creating the same product, because the same product doesn't work in all different places. So the merchandising mix of what that community needs is first and foremost what it is that we want to build. I laugh. We do have about 15% of our income stream that comes from restaurants. And when you say, oh my gosh, in a recession, isn't that the first thing that people cut off? Well, maybe to the extent it's a generic restaurant and in a community that doesn't have the wealth to be able to spend it. But when I go back to the great financial crisis of 2008 and 9, it was pretty funny. Is everybody said, Federal, you're going to get hurt more than anybody
Right.
because you have these restaurants, and that's what's going to the best performing sector of anything in our portfolio during the great financial crisis was restaurants. And I, tongue in cheek, kind of half kidding, but not really, know that if you're in Bethesda, Maryland, you're going to restaurants or you're going to starve because you're not cooking at home. These are two income families that rely on that use. And so that individual approach to every property is critical to this company. We only have, as Rob said, 100 assets. And you may think this is a very big company. We're big enough, certainly, to provide liquidity and to make sense from a public company perspective. But when you have 400, 600, 700 assets, it's very hard not to treat them as commodities simply by your abilities to run the company. We're much more specific and local in our approach to merchandising.
Right. You have 100+ assets. You've sold assets over time. You've bought assets. So I wouldn't think that you fall in love with the individuals that you're able to manage.
No, look, I'm a financial guy. I came up as a financial guy from Arthur Anderson at
Yeah.
first. I was the CFO of this company when I came in here. It's very hard for me to not understand, not fully recognize that real estate's a financial business. Now, if you can marry the financial decisions with the human decisions of where to spend and where to be, then you can create something special. And I think that's what we've done.
So I wanted to ask you just about the current environment that we're in. Just the backdrop is sending some fairly mixed signals about what the future holds between high inflation, very aggressive action by the Fed, still have a tight labor market. You're largely located in affluent areas. What are you doing to protect your portfolio over the potential coming economic storm in the next 1 to 2 years?
First thing I want to say about this, it's obviously a question that everyone's asking, but understand this. If you haven't done anything to protect yourself from cycles like this in the past, there's nothing you can do today. You are where you are. So if you haven't built your balance sheet right, if you don't own the right properties in places with affluence where inflationary pressures can be passed on at least partially to the customer, and then from us to the tenant effectively. If you haven't done any of that up till now, and now the question is, what are you going to do? The answer should be, I don't know. And that's why I do go back, and I always talk about the history here, because there is a lag. There is always a lag between how this business works in the beginnings of cycles and how it ultimately fares.
Right.
I would expect, and I don't want to sound old here, but I'm going to sound a little old here. I don't believe there's a lot of people out there these days that are important in businesses that have operated businesses, especially on the real estate side, in an inflationary environment. It's been 20 years, man. It's been so if you're 35 or 37 or I mean, the first conversations we had, the very first here, going back in the middle of COVID and then just coming out of COVID, were about what you needed to focus on in leasing in an inflationary environment. And one of my favorite topics, I mean, if you're a 35-year-old leasing person and you're asked, as we've always asked, for annual rent bumps so that your contractually goes up,
right,
and you get pushback from the tenant, which naturally you're going to get for the last 20 years, maybe you didn't push as hard, or frankly, you didn't have as much ammunition to be able to get the bumps that you do today. In an inflationary environment, I think investors ought to be asking questions about the contractual rent bumps inherent in leases. And I know that it's a critical component of what it is that we do, because if you sign a lease at $20 a foot today, that is $20 a foot 10 years from now, your property's worth half in an inflationary environment. And so you better get bumps along the way. And I'm very confident that our inherent contractual rent bumps, this is not disclosed, obviously all the way through the industry, but I'm pretty darn comfortable based on a lot of things that suggest to me that our rent bumps are better.
So it's really interesting. I remember the past 20 years has been a change from, not for your company necessarily, but more broadly for commercial real estate, moving from CPI escalators to fixed bumps, because the fixed bumps would be higher than the low inflation. And and now some of the bumps are 3 or 4%, and that actually just may not keep pace with inflation over the near term. How are you guys thinking about just those terms?
Yeah, well, first of all, there's a couple of things. Look, the bottom line is, if inflation stays at 8, 9, 10, 11% annually for an extended period of time, that's not good news for anybody. Because rents aren't going to keep pace at that level. I don't believe they will. I believe this policy will bust effectively that inflation. I think it's painful along the way, but effectively the idea of being able to ensure that your income stream is growing as best you can in negotiation, and again, you have better properties, you have more leverage in negotiation. That's not rocket science. It's just fact there, right? You'll be able to absorb what is undoubtedly the higher cost of doing business down below the line from interest expense. And so I would expect to see, as we go out forward, I would expect to see improved performance top line, in places where you can charge through inflationary pressures, and we so far have been very good at doing that. And higher interest costs and higher G&A because of the labor side. So you better have a business plan. If you're going to have higher G&A and higher interest, and I don't know who's not going to that way, you better have a business plan that compensates for that up top in the revenue line.
Before we wrap up, I wanted to ask you about ESG. It's an issue that's really important, not just for our clients, but much more broadly. And I know that Federal has been involved at the forefront of ESG for a number of years. You've put out several extensive sustainability reports. You're an active developer, and I'm curious how you're incorporating some of the best practices for environmental and sustainable development into your projects.
I love the topic, and I'm actually a little disappointed in us for most of the teams in not doing a better job communicating what we do. If you think about where we are, if you think about what you're seeing behind me and the type of properties that we do, long before ESG was an acronym for what it stands for, we were creating sustainable buildings at the forefront. I mean, we in 2010, something like that, 2009, effectively trademarked something called the green box. And a green box was, these are the way tenants were going to build out space. This was the type of HVAC that they needed to use. This was the type of windows that they needed to be in storefronts, et cetera. Here were the vendors we'd like you to consider and use. So all of that was a combination of self-serving and an understanding of our responsibilities. And so we always felt like, my gosh, in the shopping center industry, certainly, we had to be at the forefront of environmental and sustainable practices, simply because of the markets that we do business in, Maryland, Massachusetts, California, et cetera, and the product that we were building in those markets. I think over the last couple of years, we've done a really good job of expressing and communicating it better. If you haven't taken a look at our sustainability report, most recent one, please do. We are committed to being carbon neutral. And it goes beyond for us. Most shopping center companies can largely change the lights out in their parking lot. And certainly, we have done or are continuing to do that, but it's so much more than that. It's so much more than just building LEED buildings, LEED gold buildings, and LEED platinum in one or two places buildings. So the commitment is there, has been communicated a whole lot better. And I think we just put out a press release. We were just ranked by GRESB the #1 shopping center company, which is about time, because we should be with respect to ESG sustainability commitments.
Don, thank you very much. Don Wood, Chief Executive, Federal Realty. Really appreciate your time today. Thank you.
Thanks everybody for giving it to me. Appreciate it.
Good day. Cheers.